So let's go into kind of the 5 key questions. We've hit on a little bit of this, but the 5 key questions for Q3 in the second half of the year is, number 1, is how stimulative is the big reconciliation bill going to be? It is only incrementally so much more stimulative because so much of it is just a continuation of the 2017 TCJA, Tax Cuts and Jobs Act. So it is a continuation of those cuts. So the question is it additive to that? And I think it is additive to that. So you are adding fiscal stimulus to a long run period of excess fiscal stimulus, right? We have been running really crazy deficits without a recession since the kind of 2016, 2017 period, and it just keeps getting worse. So one of the arguments for why this economy has worked as well as it has, regardless of what the Fed's doing, is just because of the fiscal policy is just so loose. Think of it from the perspective of, in rough terms, we are going to collect $5 trillion in revenue. We're going to spend $7 trillion. We are literally overspending by 40% of our GDP. It's extraordinary. And there's an argument for, as long as that's the case, we're probably not going to have a recession and we're probably not going to have a bear market. Now, those theories have kind of not yet been tested. If we do have a housing downturn, if the 10-year does get away from us, whatever that driver is, but I do think it sets us up for maybe some complacency. In other words, the economy has been so strong for so long with this big fiscal tailwind. If something does get in the way, that downdraft, that concept of escalator up, elevator down, might really show its head. Because when you get into these periods of excess liquidity where everybody has convinced themselves that they're a master day trader, that usually ends badly. I don't have a time frame on when it ends badly, but I do think it ultimately does. The next question is to what degree will tariffs counteract all of the stimulus from the OBBB? And I think it will be significant, but I think it will be far more significant to the bottom half of the economy, to Americans who make less than $100,000 or $150,000 a year, because those are people that are going to consume everything that they earn. And that means that they are going to be paying the tariffs with all of their income, as opposed to somebody who makes $1 million and has savings. So the tariff only impacts the part of what they consume, which is only a small part of their overall income. So it is a very regressive tax. The question is, when do tariffs start to show up in the data? The tariffs are going to show up in the data. The foreign exporters sending products to the United States are not cutting the prices of those products, right? If you look at import prices, they are up, which means that the foreigners that send us these goods are not eating it, nor are the countries eating it through currency devaluation, given the fact that the dollar is down versus rest of world, our trade weighted basket. We talked about housing a little bit. Look, housing is critical. And the question is, does housing turn into a downturn in the second half? Our view on housing is that it's a drag and not a disaster. Our view, as I said a little bit earlier, is that, yeah, you could have some downside in housing. Affordability is really bad. Supply is increasing. Our view is on rates higher, but we do not foresee any kind of implosion, anything like what we saw in the great financial crisis. We do think housing will be a drag. We do think you will ultimately start to shed jobs in new construction as new construction falls. We do think that there will be a drag on consumer confidence to when half of the country has negative prices. Should that perpetuate across the whole country, it would be a much bigger drag. But as resilient as housing has been, with the great wealth transfer making a big impact on who is buying a house and the ability of young people, not particularly young, but mid-30s, to get into the housing market as facilitated by their generational wealth, I don't see a real negative, nasty downturn in housing, nor do we see the knock-on effects of housing-related job losses because the trades are just so damn tight. The next question is kind of global capital flight, right? When we had the big nasty sell-off that we had in April of this year, at the very beginning of the second quarter, what people noticed about that is that it was equities down, it was Mag 7 down, it was dollar down, and it was treasuries down. So you didn't have the normal flight to safety into U.S. dollar and defensive U.S. dollar denominated assets. Look, the Mag 7, I just looked at this, is 60%. The market cap of just the Mag 7 is 60% of U.S. GDP. That is in every way unprecedented, right? NVIDIA alone is like 13% of U.S. GDP, the market cap of NVIDIA. That requires this global flows into the United States. If you look at any pension fund manager in Europe, in Australia, in Japan, they are going to be very meaningfully overweight the U.S. They do not have 24%, which is what the U.S. is a percentage of global GDP, allocations to the U.S. They have much larger allocations to the U.S. dollar and much larger allocations to U.S. equities and so forth. Our only point is that the risk is that all that has to do is go lower. Portfolio managers and pension managers in Japan and Australia aren't going to turn around and say, all right, we're selling all our U.S. dollars, we're selling all of our S&P 500 exposure. No, but are they going to be less overexpressed in the U.S.? And I think that is the risk when you have as really meaningful a change as you have in U.S. policy. The most important policy change being the idea that I think that we're kind of jawboning our way to a weak dollar policy, right? Scott Bessent, Stephen Moran have both talked about kind of the cost of our exorbitant privilege, the cost of our attracting all of this foreign direct investment being a excessively strong dollar. And I know if I'm an allocator of global capital, I'm going to be worried about having a huge overweight in a country that may really truly be interested in devaluing the currency. And look, if we're going to grow manufacturing, and we haven't yet, that is going to require a weaker dollar. I'm not saying that the dollar is going to collapse, but the dollar is pretty damn persistently weak here. And it's hard to imagine that that isn't, at least in part of the Mar-a-Lago Accord and the verbiage that comes out of this administration about the dollar. The last question, and here I think we're a little bit of a contrarian on the negative side, is will there be regime change in Iran? Look, our very simple observation is that it seems unlikely to us that Israel gets right to the doorstep of regime change in Iran and makes the decision that they're not going to move forward, right? It has been the goal of the conservatives' leadership in Israel to effect regime change, to end the reign of the mullahs, and to try to beget an Iran that looks more like its population, which is younger, which is more global, which is well educated, which is cosmopolitan to some degree, right? And we'll see. My only point is that there will be disruption along the way, and in a world where sort of military warfare has been democratized, so to speak, where somebody with a few $1,000s worth of drones and explosives can make a very big impact on global trade. I find a lot of complacency around what happens going forward in Iran and in the Middle East overall.